We're opening today's breakdown with the biggest financial sector catalyst of the session, Morgan Stanley's second quarter earnings, which came in ahead of consensus expectations on two fronts that matter most to institutional investors right now: equities trading revenue and mergers and acquisitions advisory fees. This is not a minor beat on the margins. The outperformance is broad-based, touching the core capital markets engine that drives Morgan Stanley profitability in a way that has immediate read-through implications for every major Wall Street peer. With the S&P 500 down 0.7% and the Nasdaq 100 off 1.90% today, this beat arrives against a backdrop of genuine equity market stress, making it all the more significant. Morgan Stanley's Q2 2026 results beat Wall Street consensus, powered by exceptional strength in the equities trading desk and a meaningful surge in M&A advisory revenue, two lines that institutional investors and sell-side analysts watch as leading indicators for broader capital markets health. The equities trading division benefits directly from elevated institutional flows, and spring and a closing activity historically accelerates fee recognition in the second quarter. This is not luck. It is a structural feature of how deal timelines cluster. The 10-year Treasury yield sits at 4.61%, up 0.8% today, which adds a rising net interest margin tailwind layered on top of the trading and advisory beat. Here is the deeper read that matters for macro positioning. When Morgan Stanley's equities desk outperforms in a quarter where the Nasdaq 100 is under pressure, sitting at 28,470 today, down 1.90%, it tells you institutional volumes are high and two-sided, not absent. Volatility drives dealer revenues. The VIX at 16.33, even after falling 4.84% today, has been running at elevated levels that historically inflects Morgan Stanley's trading revenue higher by creating bid-ask spread opportunity without triggering a full risk-off freeze. The M&A beat is separately significant. It implies that deal pipelines that were negotiated through rising rate uncertainty are now closing, not stalling. The direct beneficiary is Morgan Stanley itself, but the read-through cascades immediately across the peer group. Goldman Sachs reports its own quarter with a similarly capital markets-heavy revenue mix, so a Morgan Stanley equities and advisory beat raises the probability distribution for Goldman's results meaningfully. JPMorgan and Citigroup carry larger consumer banking books, but both have substantial institutional markets divisions that benefit from the same trading volume tailwinds. BlackRock is indirectly exposed through EUM sensitivity. Strong M&A activity implies corporate confidence that sustains equity inflows into BlackRock's institutional mandates. The financial select sector, ticker the financial sector, is the cleanest vehicle for this read-through across the entire cohort. Three catalysts deserve your attention heading into the back half of this week and beyond. First, watch the 10-year Treasury yield, currently at 4.61%, up 0.8% today. A break above 4.75% would begin to compress equity multiples in a way that chills leveraged buyout financing and slows PE-backed M&A volumes, directly threatening the fee pipeline that just drove this beat. Second, the VIX at 16.33 is your trading revenue barometer. If it falls below 14, dealer flow opportunity compresses. Third, listen carefully to Morgan Stanley management's forward guidance on H2 deal activity. If they signal pipeline hesitation tied to rate uncertainty, peers like Goldman Sachs and JPMorgan will reprice lower in sympathy despite their own strong results. Morgan Stanley's Q2 beat on equities trading and M&A deal-making is the clearest confirmation, yet that Wall Street's institutional capital markets engine remains fully operational heading into the second half of this year. With the S&P 500 at 749, the Nasdaq 100 at 28,470, and the 10-year yield at 4.61%, the macro environment is supportive but not unconstrained. The rate ceiling is real and the tech volatility is real. Investors should use this beat as a quality signal for Morgan Stanley and the financial sector cohort, while staying disciplined about yield levels as the primary variable that could flip the M&A narrative from acceleration to stall. That is the one story driving financials today. Full breakdown is complete. If this level of analysis is what you want every single trading day, specific numbers, named tickers, macro context, and the real drivers behind the headlines, hit subscribe right now and ring the notification bell so you never miss a breakdown. We publish every market morning before the open, so you are always ahead of the tape.